So guys, February turned out to be another very interesting month on the stock market, with quite a few stocks taking deep dives. Some for good reason, others not so much. Nonetheless, all that read has created some great opportunities to swoop up some shares of your favorite dividend stocks at a discount. And in this video, we'll be honing in on 3 stocks that seem like particularly great buys as we make our way into March. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. So guys, this first stock on our list, which is Wingstop, is one that I'm sure a lot of you are already familiar with. Over the years, this purveyor of chicken wings has exploded into a global franchise and has mastered the art of making people crave lemon pepper at 2 a.m. Not only that, but Wingstop has built a pretty delicious business model that thrives on simplicity. Just chicken and fries, that's all they do. Plus, their asset-light, franchise-heavy model has made them a very sneaky growth monster in the restaurant space, which we'll take a look at in just a moment. But first, taking a look at Wingstop's share price performance over here on Snapstock, which you can get access to when you become a member of the Investment Club. And if you want to learn more about that, there's a link to it in the description of the video and in the pinned comment. But anyway, here we can see that Wingstop has had a very, very rough month. Just in the last 30 days, the stock is down about 21.7%. We can see that they have really fallen off a cliff, guys. And if we zoom out over the last year, this is going to leave Wingstop down about 33%. So a pretty big drop here too. And you know what? It really wasn't that long ago that the stock was sitting about $200 above its current share price. Back at the end of September, it was about $430 per share. So it's been a pretty painful ride down for those who bought near the top about 6 months ago. It's just crazy to see how low the stock share price has been getting. But I will say, for those of us who have been patiently sitting on the sidelines, this drop is making Wingstop look like a pretty prime opportunity, especially when you consider the reason behind this sell-off really isn't all that bad. The big catalyst behind Wingstop's drop was their Q4 earnings report, and on the surface, the results weren't bad at all. I mean, total sales grew nearly 28% year over year, which is an impressive jump for any business, while domestic same-store sales for the quarter rose over 10%. That's also really good. And for the full year, same-store sales were actually even higher, growing by about 20%, which is fantastic. And in case you're not familiar, same-store sales is a pretty important metric for restaurants as it helps them gauge, demand and customer satisfaction, and Wingstop absolutely knocked it out of the park. And as a customer myself, on more than one occasion, I can certainly attest to being satisfied after a hefty helping of their mango habanero wings. I love those things. But at any rate, moving to the bottom line, earnings per share for the quarter climbed to 92 cents, which beat analyst expectations by a nickel, and this quarter's earnings per share is up from 64 cents a year ago, which is another demonstration of Wingstop's tremendous growth. Now, having said all of that, those are undeniably very strong results, but here's where the problem lies with the earnings, and here's what caused the big drop in share price. As we mentioned a moment ago, domestic same-store sales for the quarter grew over 10% year over year. Once again, a very solid number, but the market didn't like the fact that this growth slowed compared to last year's 21% comp. In other words, growth is still there, but it's slowing down, and Wall Street hates when that happens. And also, that 10% number is slightly lower than the analyst expectations of a 12% same-store sales growth, which also added fuel to the fire. Objectively, though, that's still very solid growth, and despite Wall Street choosing to focus on the slowdown, Wingstop still seems to be one of the most impressive growers in the restaurant industry. And if we take a look at the growth metrics over here on Snapstock, this is what we're rocking with. We can see that all 3 of these charts here, from the top line all the way down to the free cash flow per share, everything is straight up and to the right. At double-digit CAGRs as well. The 5-year revenue growth CAGR is coming in at about 26%. That's very nice. Earnings per share is almost double that at 47.3%. We can see a very big jump right here. And the same is true with the free cash flow per share as well. We're getting about a 15% 5-year CAGR in the free cash flow. And as I'm sure you can imagine, all that growth in the financials has certainly had a positive impact on the dividend. Right off the bat, though, I will say, starting here with the dividend yield, Wingstop does not have the most exciting yield. Right now, it's only at 0.4%, but I think that's pretty typical when it comes to companies with a financial profile like Wingstop. When you see these really growthy companies, solid revenue growth, earnings growth, free cash flow growth, all of that jazz, you'll typically see these lower starting yields, but pretty crazy 5-year dividend growth rates. And despite what this chart says right here, that's what's going on with Wingstop. I mean, it has the 5-year CAGR at minus 35%, but these years right here are throwing off the reading. These are actually special dividends, and Wingstop pays out special dividends, as we can see, very large special dividends every couple of years to shareholders. And like I said, that's throwing off this number right here, and Wingstop's real dividend growth CAGR is sitting at around 20%, so very impressive dividend growth from this company. Despite the recent share price performance, Wingstop has been an incredible grower, and I'd be very surprised if they didn't continue raising their dividend pretty aggressively as the years go on. Overall, I just think this is a great dividend growth stock to consider. Now guys, we talked about Old Dominion Freight Line, ODFL, just a couple of months ago, relatively recently, but in the last month, the stock has seen just a ridiculous decline. Back over here on Snapstock, Old Dominion has declined 8% just in the last 30 days, a very, very crazy drop, and this is going to leave the stock down about 20% in the last year, so another pretty big drop here. And I've got to say, the reason for this drop in the last month, at least I think, was pretty wacky. Basically what happened was there was a perfect storm of news that came out and hit Old Dominion all at once, and investors just went running for the hills. First, JP Morgan issued a research note warning that Amazon might enter the less than truckload or LTL market as a for-hire competitor. This is a big deal because Amazon has a massive logistics network and the financial muscle to enter the space in a meaningful way. And even though Amazon hasn't officially launched this service, the rumor of them doing so was enough to cause a widespread panic in the market. Then, to make matters worse, the CEO of TFI International, which is another major player in the LTL space, came out and basically confirmed that freight demand is in a deep recession. He called the current market environment very, very difficult and warned that the first half of 2025 could be even worse than the first half of 2024, which is the last thing you want to hear if you own shares in a trucking company. At any rate, as I'm sure you can imagine, both of these things had a pretty negative impact on Old Dominion's share price and caused it to drop over double digits in one day. Here's the crazy thing though, just a few days later, analysts at Stifel came out and basically said, never mind, Amazon disrupting the LTL industry is a classic case of much ado about nothing. They said this rumor pops up every few years, but actually turning Amazon Freight into a real LTL competitor would take billions of dollars and years of development, even with its existing infrastructure. So basically, guys, it was a classic market overreaction. But I'll tell you what, we'll take it because any sort of short-term news, any sort of short-term noise like this only creates better buying opportunities and allows us to buy shares of these great businesses, which Old Dominion is. It allows us to buy these great businesses at that lower share price while at the same time locking in a higher dividend yield. And on that note, taking a look at Old Dominion's dividend stats right here, kind of like with Wingstop, Old Dominion's not going to be the highest yielding stock, but also like with Wingstop, this is a very growthy company. So it's no surprise to see the yield where it is, about 0.6%, and this has been a crazy dividend grower over the years. Look at this chart, guys. This is a real work of art. And the 5-year dividend growth rate is over 36%, which you'd be hard-pressed to find a higher dividend growth CAGR than this one right here. And if we scroll down just a little bit, fortunately for us, this dividend is also very well covered. Looking at the earnings payout ratio, we do see an upward trend right here where the payout ratio has increased over the last couple of years, but still, in the trailing 12 months, it's less than 20%. So very strong dividend coverage, even despite this upward trend right here. And the same is true with free cash flow payout ratio. Looks like in 2024, that came in at about 25%. So still plenty of room to continue paying and growing that dividend. And like Wingstop, guys, Old Dominion is also on my watch list, but truth be told, I could see myself buying shares of Old Dominion and starting a position in this company sooner than I would Wingstop, and we'll see what happens. But I think this is a really cool business, and I'd be very interested in owning it. And I'm really watching it close because the share price is starting to look pretty good. We'll see what happens. So guys, stock number 3 is Clear Secure, which, as a lot of you guys know, is the most recent addition to my portfolio, and 2025 so far has not been kind to this stock. Taking a look at the share price performance over here, we can see that just in the last month, Clear is down about 3.25%. Not the craziest drop, especially compared to the previous two stocks that we saw. And actually, Clear's had a very good day. It's up about 5% today, just as I'm recording this. But if we zoom out looking at the year-to-date performance, like I said, 2025 has not been kind to the stock. It is down over 13% 14% here. And if we take a look at my Clear position over here on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download the spreadsheet in the description of the video. But here we can see I have 106 shares of Clear at an average cost of $29.57, and I actually picked up 2 more shares today, so that brought my average cost down just a little bit, but still my average cost per share is so much higher than the current share price of $23.71. Unfortunately, today was a really good day, but like I said, guys, this has become my portfolio's biggest loser by a long shot, and I'm down about 19, almost 20%, both in terms of share price and total returns, including dividends. Either way, it's not looking too good for me here. Now, truth be told, I really can't tell you why Clear has been performing so poorly here year to date, but I will say more recently, they did see a pretty big drop in share price after reporting their Q4 earnings, which, like Wingstop, were actually pretty solid, but the share price still saw a very big drop from the earnings release. And taking a look at my personal notes from the call, revenue was up over 20% year over year, so very solid there, while free cash flow for the year saw a crazy 42% increase, which certainly bodes well for the dividend. In fact, they actually announced a pretty big special dividend that they'll be paying in March, which actually comes out to be more than twice the amount of their regular dividend, so that's pretty cool. And like I said, guys, I'm kind of dumbfounded actually why this stock has dropped so much. Maybe it's because they saw a pretty crazy run up prior to the big drop, so maybe it's just things kind of leveling out. But financially, this stock still seems to be just firing on all cylinders. It's growing like a weed, so not exactly sure. The market is strange sometimes. But anyway, taking a look at the dividend stats over here, Clear is a relatively new dividend payer. They only started paying a dividend just a couple of years ago, so it's still very fresh. And right now, the yield is looking pretty good. It's coming in at 3.1%, but I do believe this includes the special dividends that they pay, so definitely keep that in mind. And because this dividend has only been around for a couple of years, it's too soon to come up with a dividend growth CAGR for the company, but I would be very surprised if in a few more years we didn't see it above 15%. And if the company keeps growing at this rate, I could see it even hitting over 20%. We'll see what happens. But nonetheless, I think Clear is looking like another solid contender if you're in the market for a great dividend growth stock. And I think the same is true with all 3 of the companies we've looked at today. With that though, these 3 are not the only ones. There are still a handful of other stocks out there that I think you need to keep your eye on. The first of which is going to be Boise Cascade Company, ticker symbol BCC, who is down 18.6% just in the last 30 days, a crazy drop. And if we zoom out over the last year, BCC is down about 20.5%. And then guys, next up we have Caterpillar. Definitely keep your eye on this one because it's also seen a very big drop in the last month, down about 14%. But if we zoom out over the last year, it's still in the green by about 4.5%, but it's making its way south. We'll see if that keeps going. And then guys, keep your eye on Comcast as well. The stock is down about 4.8% in the last month, but if we zoom out over the last year, it's down 13.6%, so it could be another solid contender. And then moving on, I still think DR Horton is a stock to keep your eye on. In the last month, it's down another 12%, a crazy drop for this company. If we zoom out over the last year, it's down 14.6%, so that share price just cannot seem to catch a break. And then guys, here's a stock that I haven't talked about for a while, but KRC, definitely keep your eye on this one. I don't think now's a bad time to pick up some shares of KRC actually. In the last month, it's down 8.6%, so a pretty big drop here. And if we zoom out over the last year, it's basically break even. So I don't think now's a terrible time to consider some KRC. But anyway, moving on back to the home builders, we already mentioned DR Horton, but Lennar, ticker symbol LEN, is another one to keep your eye on. Also seen a pretty big drop here. In the last month, it's down 11.5%, my goodness. And if we zoom out over the last year, Lennar is down 23.8%, so a very big drop. And then moving on, I know a lot of you guys out there are starting to buy this one again. This one is Microsoft. I can't tell you the last time I talked about Microsoft here on the channel, but in the last month, the stock is down over 10%, and it looks like it's down another 1.8% just today, officially below $400 per share. And then if we zoom out over the last year, this is going to put Microsoft in the red, down 3.5%. So could be a good one to keep an eye on. But anyway, moving on, guys, we talked about this stock in last month's video. This is Rexford Industrial Realty. It was actually like my top dividend stock to buy in February, and it's kind of break even in the last month. It's up 0.6%, which is nothing crazy, but if we zoom out over the last year, Rexford is still down 15.7%, so I definitely think it's one to keep an eye on. But anyway, now moving on to another company that I feel like I haven't talked about for a long time. This one is Target. And in the last month, Target's seen a crazy drop down over 12%, which is going to leave them down 16.25% in the last year. Big drops in both departments, so keep an eye on Target. And then guys, Zoetis is also looking pretty dang interesting. In the last month, the stock is down another 3%. 20%, and if we zoom out over the last year, Zoetis is still down almost 15%. So I think this is one to consider for sure. This is a great company. But anyway, those are all of the stocks that I think are ones to watch right now. And if you want to hear about a handful of other stocks that I'm most definitely staying away from and suggest you do the same, then check out this next video right over here. In this one, you'll learn about 3 dividend stocks that many investors like to buy, but truth be told, they're terrible investments and you should avoid them at all costs. So click right over here to learn about those, and I'll see you in the next one.